G'day Fools, I'm Scott Phillips and welcome to another Motley Fool Stocks in Focus where we take a deep dive on the companies that you own, the companies that are most popular, most owned, frankly covered in the market today. What do the Motley Fool analysts think of some of these businesses? And I'm pleased to have with me the Motley Fool's Director of Research, the man who makes it all happen, Kevin Gandiya. G'day KG, how are you mate?
Very good, Scott. Thanks for having me.
Pleasure, mate. Thank you for taking the time to join me, to join us, because we're talking about the Silver Donut, the Millionaires Factory, the company that has more nicknames, I think, than pretty much any other business on the ASX. We are, of course, talking about not Macquarie Bank anymore, but Macquarie Group, the business that was once Macquarie Bank, but has become, in some ways, so much more, in some ways, so much less. Macquarie has been through, I can't think of how many iterations of business models since I've been following the company, maybe 3, maybe 4 different generations. One thing we know about Macquarie, mate, is that if they can smell a dollar to be made, they will go in that direction. That's probably one of its key attributes, by the way. So I'm not going to give away too much of what you have to say. First thing I'm just going to do is say, can you help us understand in a bit of detail what the Macquarie Group of today looks and feels like? What is the company made up of? What does it do? How does it make its money?
Cheers, mate. And you're very kind. The Millionaires Factory is one way of describing Macquarie. I think there are less flattering nicknames out there, so I'll leave them to that.
Oh, mate,
But
it
yeah,
could be
let's talk
worse. It could
about
be what's Goldman Sachs the Vampire Squid, isn't it? I think that was the worst one I've heard. Is Macquarie
yeah,
have those similar sort of nicknames?
that's the one, mate. And I don't think they'll be too bothered by it, mate. I think it
I
as
don't
long
think
as
so either.
they're making the money, it should be all right.
Yeah. Sorry,
Yeah,
mate. So
but
go on. Tell us about Macquarie.
yeah, let's get into it, mate. And look, Macquarie, I think the name Macquarie is quite familiar to many Australian investors, but to actually pinpoint exactly what they do can be a bit tough because they do describe themselves as a diversified financial services company. And when you dig into the details, you start to understand why, with the roots and the history of this company, it tends to be more in the investment banking space. But today, I think the best way to understand the company is they kind of split the business into two separate operating models. The first one is this annuity, what they describe as an annuity style business, companies that are in this annuity style business model. And the reason why they describe it as annuity style is because the way that the businesses in this segment generate their revenue, it tends to be in a recurring manner. So as an example, they have what they refer to as Macquarie Asset Management. This is the large infrastructure asset manager, and they manage many different types of infrastructure in there. So they are one of the largest infrastructure managers in the world, and the way they earn revenue in that group through performance fees and management fees. So typical to and similar to what a normal fund manager would do. Another business they have in that annuity style operating segment is the Macquarie Banking and Financial Services model, a company. And this one is probably more similar to traditional banks that we know here in Australia. It's more similar to the CBAs and the Westpacs and the NABs of the world. They provide personal banking, vehicle finance, asset finance, that sort of finance. So that's the annuity style side of the business. And then the second part of the business is this capital markets facing bit of the business. And in there, they've got the traditional Macquarie Capital. That's the traditional investment banking service that they provide. And investment banking, really at a high level, is just helping companies to do things like raise capital and giving advice to those companies on issues like mergers and acquisitions. They also have the Macquarie Commodities group in there as well. And the commodities market group, what they basically do is they help companies that are exposed to metals or energy or gas or agricultural type products, and they provide very specialist financial products to help them manage the risks in those sectors. So it could be hedging, complex hedging, financial instruments to help with, to hedge your commodity risk. So if you want to make sure you're controlling the price of sugar or cotton or maize or whatever the case may be, they can help hedge that for you, or foreign currency risk. Or any kind of complex risk that you may face in the capital market. So that's at a very high level what Macquarie Group does, very diversified. And we can probably talk a little bit more further on about how these different divisions interact.
Yeah, let's do that, mate, because that's a fantastic summary. And in kind of I'll say a normal business, I don't mean Macquarie's abnormal, but in a normal business, having just one of those divisions would be an entire business, right? You think about the banking business, as you rightly say, we do have banks that literally that's what they do. So the Macquarie Bank inside Macquarie Group is kind of akin to the CBAs. The Macquarie Investment Bank is akin to the Goldman Sachs of the world or others. The capital markets business, again, and the commodities business, you kind of nicely laid that out. When it comes to, I guess, let's kind of take them in turn to some degree. You started off talking about the asset management business. They announced recently plans to raise $7 billion with a B for infrastructure financing in North America. And it seems to me that on one hand, who needs Macquarie, right? You can have an infrastructure asset, you can invest in that asset. You don't need to have Macquarie necessarily, but Macquarie provides that layer of financing, aggregation, deal selection, all that kind of stuff. They are kind of the consultant or the expert in the room where you say, well, I could do it myself, but I could pay Macquarie a small fee, a portion of the fund, to let them organise it. The management itself doesn't take all that much. They don't literally go and paint the bridges or rebuild the roads, but they are managing the financial kind of structure around the assets, right?
Yes, that's exactly right, Scott. And these days, infrastructure is big business. We know that in a low interest rate environment, there's so much money chasing these types of assets. And because they're very long dated assets, infrastructure assets can literally have 50-year lifetimes, even longer. And so, the types of companies that invest in these types of assets are typically pension funds or super funds, as we know them here in Australia. And, as they are taking care of member funds, they do have that extra layer of due diligence. And as part of their internal processes, they do tend to hire companies like Macquarie, which specialize in this sort of thing. I do think, Scott, I do think there is an element of Macquarie relying on that reputation to be able to manage those infrastructure assets. I think if it was smaller players, they may look at it and say, why do I need to pay all these fees to get someone else to do it? But when it comes to those aggregated larger global funds, they do tend to just delegate some of that work to Macquarie. Yeah.
It does strike me, and this isn't a Macquarie comment generally, maybe a Macquarie observation generally. You may even disagree, so feel free to. It strikes me that, there's the old sort of, well, I could sell my own house, or I could get a real estate agent to do it for me. I could, try and do my own deal over here, but I could get someone who's expert. I could do my own conveyancing, or I could get a solicitor to do it for me. There is some sense that, yes, while Macquarie makes a very pretty penny, they make a lot of money doing this. It's kind of one of those things of, do you really want to take the risk? I could sell my own house and I could save myself 20, 30, 40 grand. Or maybe the real estate agent gets me 100 grand more for my house, in which case they've paid for their fee a couple of times over. There is some sense, I think, with Macquarie that these guys are the experts, because not every business has that in-house expertise. I'm not a real estate agent, my wife's not, so I could do it myself, or I could go and pay a one-off fee to someone who does this for a living, who's an expert, who knows the ins and outs, who knows the tips and the tricks. That's kind of what Macquarie brings, right? It's an imperfect analogy, but that agent idea, sitting between two parties, say, hey, we do this for a quid. We know what you need to know. We do this every day. You do this once every 5 years. Let us help you with that. Does seem like the crux of what they offer, generally speaking.
Yes, that's right. And to be fair to them, they have generated that track record over time. So it's not as if they just people have come out of nowhere to try and do this. They have developed that track record over time, and it's quite astonishing. They're actually managing over $500 billion worth of assets in that infrastructure side of things. It can sound like big numbers, but obviously infrastructure projects do have large numbers involved. So that is a big money spinner for Macquarie.
You say too they've been around and people do know them, have a reputation for it. That's fair to say. Babcock and Brown was the mini Macquarie during the GFC, which of course famously went broke because it kind of collapsed under its own obligations. To some degree, Macquarie has been there, done that, and has a reputation, as you say, of doing it well. The banking business that we talk about, the kind of more traditional banking, the Macquarie Bank business, I've noticed that you probably have too, a whole lot of Macquarie Bank ads. The home of good borrowers, I think they're kind of calling themselves. I'm paraphrasing a little bit, something like that. And again, whenever we talk about Macquarie, it's one of those things where if you hire the smartest people and they can see some money to be made, you kind of want to back them rather be on the other side of the transaction, right? In this case, it seems to me they've kind of looked around the market and gone, hey, where can we make the most margin? They've said, well, hang on, if we can go to the best borrowers with the best credit ratings, by definition, defaults should be lower, so we can charge a little bit less. We'll effectively skim the quality off the top and attract those specific borrowers. The marketing is really, really transparent. I'm not sure if this is transparent for the whole market or as people who know kind of can read between the lines of what they're looking for. But they've kind of chosen themselves a very specific segment of the market to say, we'll cream the quality, thank you very much. I assume the bank is attractive to those sort of borrowers. Maybe the rates are better, maybe the branding's better. But it's a clever strategy, right, to kind of segment the market, only take those bits you want.
Absolutely. It's really clever marketing, Scott. And I think it is actually working. When you look at their latest report, Macquarie does have that 31 March year end. So we do have fairly recent year end numbers from them. And when you look at go into the detail of their report, you actually realize that their loan book has been growing at a pretty decent clip. So it suggests to me that they are actually taking market share from some of their other competitors, and that's been driving growth in that banking and financial services industry. Of course, it is kind of give and take because as that loan book has been growing, they have been facing other headwinds with margins compressing, thanks to lower interest rates this at the moment in time. But overall, I do think that banking and financial services industry, I would have actually thought, or at least someone looking at this at a high level would have thought they don't focus too much on it. But it seems like they definitely are, and they are actually taking market share, which is good for them.
Nice. Let's go to the other bit then, the non-annuity business, the capital markets, commodities businesses. I'm kind of interested in this one. By separating those out, they seem to be implying these are volatile businesses, or we should expect losses, or you simply just don't know how much money you're going to make in any given year. Can you kind of help me understand? You talk about what those businesses did, but is that why they're separating them out? They're trying to get us to focus on the recurring part, and then try and separately value this kind of, I won't call it mercenary because that has a negative sense, but they're kind of going, they're chasing the deals when the deals are there to be had. Some years there's lots of them, some years there's not many. Is that kind of how we should think about that other second part of the business?
Yes, that's absolutely right. It's a very volatile business because it basically the business itself, that capital markets facing business, by definition actually responds to the current market conditions. So when there are a lot of deals to be done, lots of M&A activity, this is a business
Yeah.
that definitely benefits a lot. Investment banking is one of those industries where the bills that they provide to their clients are not really time based. It's really based on success and the size of the overall deal, so percentage based fees. And so they can really leverage that off during the good times. But during the bad times, if there's no business or there's not too much business going around, then they don't benefit as much. And interesting, when you look at the most recent report for this company, the commodities business net profit in that business was actually up some 50%, which is surprising for a business as large as Macquarie. And the reason is because if you look back over the last year we've had, Scott, there's been a lot of volatility in the equities markets in general, but more specifically, if you look at energy and gas markets, I think at one point, oil, for example, was really rock bottom. Oil
That's
prices,
right.
and then they're kind of shooting up again. Oil companies starting to do well in the markets. In North America, they've had their issues with gas supplies and things like that. And so there's just so much volatility in this market. And so in times like that, when there's a lot of volatility, what companies are looking to do is to actually hedge that risk. And they typically go to companies like Macquarie to help them hedge that risk. So you actually find that in recent times, that commodities business has been doing very, very well for Macquarie. And then in other years, you see that investment banking business, that Macquarie Capital business, doing very well, as there's a lot of, I guess you could call it free money or easy money going around, deals flying around everywhere, and that really tends to help them a lot. So yeah, it is a volatile business, and I think it's also a business during the most extreme times that can suffer extreme shocks. So if you look at the GFC period around 2008, 2009, that was a really terrible. That was a financial crisis. So investment banking companies and banks in general were not going through a great time, and you could really see that in Macquarie's performance. So I think management have done a great job over the last 10 years to diversify away from that volatile business, even though it is a highly profitable business in the good times, to kind of smooth out those returns. Because we know investors, they do like a level of predictability in earnings. So I think investors willing to sacrifice some of that additional upside that comes from the good times if you can smooth out those results with that annuity style income.
Makes sense. If you're a business that deals with shareholders and counterparties, and you're a listed company, you're probably going to take a pretty keen view on what your shareholders are looking for. Mate, let me ask one last question about that commodities business, then we'll get into the pros and cons of the investment. This entry into the commodities business is relatively new. I think it's the newest of those four pillars, although you may correct me if I'm wrong, or maybe it just was much smaller in the past. It was a fascinating one for them to get into because commodities trading it's not a traditional investment banking operation necessarily, and to some degree commodities traders have been at the outsides of some of the more respectable financial transactions. They've been the kind of the Wild West, the cowboys. I know I'm probably insulting a whole lot of people here, but generally speaking, it wasn't kind of one of those core investment banking kind of sandstone pillar operations. It was on the outsides. It was pork belly futures and corn and cotton. So I'm fascinated to see them move into it. I'm going to assume they've done it because they see some money to be made. But I'm just interested in your view, if you have one, on that kind of creation or enlargement of that part of their business, given what they've otherwise got, given that it's a relatively new and unusual thing for kind of an old school investment bank to do.
Yeah, that's right, Scott. I think when you look at it, I think there is just a lot of business to be done in that area, and so they've identified that as an opportunity that they can actually move into. Um, I don't think it's a business that's been around for too long, or at least they haven't been generating a lot of money from it
Yeah.
in the past. But it's certainly grown as the world has become a little bit more complex. And I think, in a sense, they, I guess, trying to position themselves as a form of market maker, basically trying to help clients navigate the different risks in the market. Now, a cynic out there may say, clients should be able to just navigate those risks themselves, be able to
Yeah.
go through the cycles. If you're a mining company, or if you're an agricultural company, or any company that's exposed to those commodity or cyclical type risks, you should be expecting it
Mm-hmm.
by virtue of your business model. So you shouldn't really need that hedging over time. But as we do know, everyone likes that level of certainty. Some of those exogenous risks, when they do manifest, they do tend to have outsized impacts on companies. So companies do like to smooth some of those risks. And to be fair to Macquarie, they've done a great job of positioning themselves in that market. If you think about North America, for example, it's a region where weather shocks can have very real effects on cities and on states. Scott, I don't know if you remember, more recently, I think it was during the recent North American winter, the Texas market actually ran out of
That's right.
electricity. That's something
That's right.
that's hard to imagine for us here in Australia, but it does happen, especially when those extreme weather events happen. So Macquarie is just one of those companies that can position themselves to benefit. And it sounds wrong to say benefit when bad things happen, but it
Yeah.
is, I guess, managing risk is probably the more polite way to say it.
Whether it's more appropriate, it's different. Definitely more polite. Yeah, look, there is some sort of commonality across those four business models. And look, Macquarie is the ultimate, the consummate middleman, right? If you think about any of the things we've just talked about, whether it's the party between the asset owners, the infrastructure owners, and the infrastructure investors, whether it's the middleman between the borrower and the lender, whether it's playing that advisory role when a deal is being done between a buyer and a seller, both in capital markets and commodities. This is exactly what Macquarie is doing. Tends to be, generally speaking, relatively capital light. The banking business, not so much. The others, pretty capital light unless they're investing their own money. And again, Macquarie is very good at sniffing out a buck. So maybe there's no surprise those four elements come together. Mate, let me ask you then to argue both sides of the street, both sides of the coin. Can you just put your Bulls cap on for a sec and talk to me about the bull case for an investment in Macquarie Group?
Yes. So I think the first thing when you look at Macquarie is it's a company that has had a very long history and a long track record of performing and delivering results. So I think investors that look for that, I guess, blue chip level of quality in a company will be interested in Macquarie as a business. That's the first thing. And the second thing is we know banks are a popular investment vehicle for many investors here in Australia, but Macquarie really stands out and differentiates itself from its competitor banks in the sense that we've just been talking about the different types of businesses that sit under that one big Macquarie brand. And so it's a far more diversified business than some of our other local large banks are. And even just in terms of where its revenue comes from. So it's not just diversification in terms of the types of products and offerings that it provides, but it's also diversification in terms of the geography and where the sources of revenue actually come from for this business. So North America, for example, accounts for some 30 something percent of profit for Macquarie. Same for Australia, accounts for some 30 something percent. Europe, Middle East, and Africa, some 23 or so percent. And then they also have exposure to Asia, which is around 11% of their business. So they are basically generating revenue almost all over the world. And so if there are any specific impacts in certain geographies, they can kind of weather that storm with good times in other parts of the world. And also, if there's one type of business that's not doing so well, they can kind of, I guess, weather the storm elsewhere. So, to give you an example, Scott, if, for example, something happens with the local economy and that affects the housing market, that's probably not great news for all of our local banks. But Macquarie could, and it will, still wouldn't be great news for Macquarie, but they can still offset that with income coming from North America, from commodities trading, or from investment banking in Europe, or whatever the case may be. So they can really just manage that income across the entire business. The other thing, which I also think is quite bullish for this company, is that for investors that are looking for income, I think Macquarie presents, again, an interesting opportunity. Obviously, it's paying around 3 to 4% dividend yield. Now, ordinarily, some investors may feel like it doesn't really matter whether the company pays a dividend or not. But just looking at our overall investor base here in Australia, if income does make a difference, particularly if you are looking for that as part of your portfolio. So there is, I think, a decent level of demand for investors that are looking for that type of business to include in their portfolio. And overall, when you look at the management team, I think one thing they do deserve credit for is they've been able to pivot their business to respond to whatever the current market environment demands. You've mentioned the business has sort of changed 4 or 5 times since you've been following it, and that's exactly what Macquarie is trying to do, right? They're basically, as you were saying earlier, the middleman of financial services, and they will likely just continue to reinvent themselves and repivot their business to move wherever the dollar is going. So that's to their credit. And I guess the other thing as well is, we do laugh about it as being referred to as the Millionaire Factory. I do think those incentives have a very real impact in terms of how motivated employees are to hit those financial goals.
Right.
Obviously, not everyone will agree in terms of money being the sole motivator in terms of how employees want to work. But I do think in terms of just driving the pure hard results from a financial perspective, I do think that has an impact. And Macquarie is one of those companies where that is not shy to reward some of its best performing employees. I think in some years, some of the best performing investment banking directors have actually out earned the CEO thanks to those well crafted bonus plans. So this is a business overall that can really move around the world and gravitate in different geographies and different types of markets to do well for their shareholders. So I think overall, investors that are looking for that income will probably find that interesting from that perspective. So I think that is at a high level the bull case for Macquarie.
Mate, you've done a spectacular job of outlining it. As you're talking about it, I'm thinking about, those strike teams of kind of, I'm trying to think what they are, the ex-army kind of mercenary groups. And you kind of, you get together, you go where you're sent, right? You work for big dollars and you go and get the job done for whichever party's hiring you. Again, I don't mean to be overly pejorative about it. It's not necessarily a bad thing, but Macquarie, as you say, very good at sniffing out a big deal, going and getting it done, rewarding the people who are involved, and aligning those incentives beautifully, mate. So you've done a great job with the bull case. I want you to do an equally good job with the bear case for me. Try and convince me after your bull case. Try and convince me not to buy shares in Macquarie. Why would I want to stay away from Macquarie as an investment?
Yeah, so I think the first issue for me when I'm looking at this company is the issue of growth. I think, given how big the company already is, and given that they're trying to do so many different things at the same time, I've got question marks in terms of how quickly and how sustainable they can maintain a decent growth rate. I think growth is likely to be a little bit subdued for this company, just at the overall level. It's just the law of large numbers, right? The bigger you get, it just becomes much, much harder to keep generating incremental levels of growth. And sometimes that's okay. But I think for investors that are really looking to, generate exponential returns, multi-bagger type returns for their portfolio, I don't know if Macquarie is top of the list in terms of being able to generate those types of returns. The other thing is it's quite a highly regulated business. I think almost every day, first of all, let's just talk about regulation, right? This is a banking business, so they do have to comply with things like Basel requirements, different types of local regulations in every geography that they're operating in. So from a capital perspective, they do need to maintain a certain level of capital for their business, and that naturally creates a constraint on how much capital they can actually deploy. So more recently, they announced that they suggested that they would likely be a bit more conservative with how much they're paying out from their profits as dividend. Typically, Macquarie looks to pay out anywhere between 60 to 80% of their profits in dividends, but it looks like they'll probably be cutting that to somewhere between 50 and 70%. And the reason is because they're just trying to keep a little bit more capital on their books. As a defensive measure, just as we're still navigating this COVID pandemic, and also as a potentially as just to keep a cash buffer in place and put some cash to work as opportunities arise. So I do think that regulatory aspect will continue to be there. It just doesn't go away. It's the nature of the beast, but it does put a constraint on growth. The other thing is this is a business that is consistently in the headlines, and there's a lot of scrutiny placed on this business from politicians, from the media, and it's typically not always good, to be frank. And so it almost feels like every now and again there's a negative press or a negative story that comes out in relation to this company, and they literally become associated with whatever deals they do or whatever clients they represent. So if there's an IPO that doesn't go too well and Macquarie is the representing bank, that kind of reflects negatively on this company. So just in terms of the overall sentiment around the business, that can ebb and flow over time. And I think if you're a long-term investor looking over 3 to 5 year and longer periods, you almost have to expect that these sort of things will come every now and again. And that is typically not always good for the share price. The other thing is that we talked about market shocks earlier, and Macquarie obviously has been around for a while, so they do have risk management policies and procedures in place to help their business survive those shocks. But sometimes the shocks can just be so big that they sort of drag everyone involved in the industry. So I think, especially when you look at the global financial crisis, and if you look at where we are positioned in the world at the moment with very high property prices, low interest rates, central banks printing money effectively, I do think that if we were to experience a significant shock, it really could affect a Macquarie, whether in terms of any kind of loan exposure they have to the property market, or any kind of exposure they have to the broader capital market. So just from an exogenous shock perspective, they do have a level of exposure to that. And I think for investors trying to analyze this business, it can be hard to really pinpoint where those shocks can come from. It almost becomes that unknowable risk that you do know exists, but you just can't pinpoint exactly where it could come from. So overall, that's something to look out for. And finally, just from a valuation perspective, I don't know if now is the current share price is the cheapest that you can ever get at Macquarie. It currently trades around 14 times earnings. That's not terribly expensive, but I do think that I think actually earnings around the PE is around 19 times earnings. So I think there have been times where it's been a bit cheaper, around 14 times, but I think at 19 times, it's probably closer to fair value, if not just a little bit over. So if your valuation, I think for lower growth business, you do have to be a bit more mindful about valuation. And so those are some risks to consider.
Mate, you've done a stunning job as always. So he's a smart bloke, isn't he? We're very lucky to have him. KG, before we go to our final conclusion, I just want to share a couple of things. The first is your Twitter account. If you are on Twitter, follow Kevin. It's at Kevin Gandiya. Am I right about that?
That's correct, Scott.
There you go, at Kevin Gandiya. If you're also on Twitter and you want to follow some other accounts, you can follow the Motley Fool at the Motley Fool AU. And you follow me at TMF Scott B. We're on Instagram as well, the Motley Fool AU and TMF Scott P. And on Facebook, the Motley Fool Australia and Scott Phillips Money. You can follow us all there. You can, of course, check out our podcast as well. While you're here, don't forget to like and subscribe to our Facebook, to our YouTube channel, to make sure you get the next one of these. Kevin has a smart team of analysts working for him who do a spectacular job. You hear Kevin's quality already. The other guys are just as good. And so you really want to make sure you don't miss out our regular now video series like Stocks in Focus, like Stock of the Week, a whole lot of media stuff we do. Deep dives like we did this week, by the way, into Afterpay's takeover by Square. If you haven't seen that, make sure you do. All right, that's enough of an ad, Kevin. Let's get to tin tacks, mate. Look out 3 to 5 years for me. You've described the business beautifully. You've given the bull case comprehensively. You've given the bear case very fulsomely, and I'm now not sure which way you're going to go. So I'm as interested as everybody else. If you look out 3 to 5 years and beyond, given that if you don't want to beat the market, you can simply buy the market, buy an ETF. Let's assume that our viewers are looking to deliver market-beating returns, or maybe income first. So we talk about that maybe separately. But if you're looking to beat the market and you're looking out 3 to 5 years, are you buying shares in Macquarie Group?
Yeah, so that's an interesting one. And as I was considering this one, as a growth-focused investor, I'm not thrilled by the low levels of growth in this company. But overall, when I look at everything that Macquarie is doing, I don't think it's a dying business. For example, in the infrastructure business, a lot of the infrastructure assets are pivoting towards renewable infrastructure. And so whether renewable energy does take over from traditional source of energy or not is besides the point, right? There's just a lot of money that's being invested in that area, and so Macquarie is a company that benefits from that. So I think there's a lot of money pouring in that area. And when I look at management's track record of being able to navigate different market environments and being able to come up with new businesses, that is quite bullish for the company. Also, there are other areas like which we haven't even discussed today, like wealth management, for example. While we find that the wealth platforms for the traditional big banks, funds flowing into those platforms are moving away into new age platforms like NetWealth and Hub24, Macquarie is actually one of those older banks that's still getting large volumes of funds flowing into their platform. So to me, it suggests it's a company that's able to reinvent themselves, keep themselves relevant to the current market environment. Whilst growth is not hyper growth or high growth for that matter, it is still a profitable company. The bottom line is still growing. And so I think overall, Scott, I do think Macquarie is a market beating stock over time. I don't know if it's a market crushing stock, but I think it's got a good chance of beating the market.
There you have it, fools. One of the brightest brains in the business with his deep dive summary of Macquarie. Kevin, thank you for taking the time, mate. I really appreciate it. I've learned something as well. We actually have Macquarie as an active recommendation at Share Advisor, by the way. So I knew a bit of that, but I learned a whole lot more, which is fantastic. Mate, I should ask you, do you own shares in Macquarie, Hub24 or NetWealth?
No, I do not. I did used to own shares in Macquarie. I wish I'd kept my shares because it's done pretty well.
Exactly. Thank you for that disclosure. There you go, fools. That's our latest Motley Fool stock in focus. Come back next week for another one. Don't forget to like and subscribe to this video. And until we see you next time, Fool on.